Hello everyone! Today we're diving into the exciting world of options trading, specifically a strategy called the short iron condor. Now don't let the name intimidate you. It might sound complicated, but I promise to break it down in a way that's easy to understand. Options trading can seem like a whole other language, but it's really about using contracts to potentially profit from the movement of underlying assets, like stocks. Imagine it as a side bet on whether a company's share price will go up, down, or stay relatively flat. The short iron condor is one such strategy that allows us to make educated guesses about a stock's price movement within a specific range. The beauty of this strategy is that it's designed for volatility, meaning it can be particularly profitable when the markets are a bit shaky. So, if you're ready to learn how to potentially capitalize on market swings while keeping your risk in check, then buckle up, because we're about to embark on a fascinating journey into the world of the short iron condor. Now, let's delve into why the short iron condor is considered a volatility play. As I mentioned earlier, this strategy thrives when markets are a bit unpredictable. Think of it this way: when a stock's price is expected to move significantly in one direction, options that benefit from that move become more expensive, just like how a hot concert ticket gets pricier closer to the date. The short iron condor, however, profits most when those options' prices decrease. This happens when the market calms down and the stock trades within a predicted range. We're essentially betting that the big price swings everyone is expecting won't actually happen, at least not within our set time frame. So in volatile times, when fear and uncertainty are high, option prices tend to inflate. This presents a prime opportunity for short iron condor traders who are essentially selling those inflated options and hoping for a calmer market to work in their favor. Like any good investment strategy, the short iron condor comes with its own set of risks and rewards. The good news is that both are limited, offering a degree of control that many traders find appealing. Let's start with the potential reward. When you execute a short iron condor strategy correctly, your maximum profit is capped at the net premium you receive when you sell the options. It's like baking a cake. You know the maximum size it can be based on the ingredients you put in. On the flip side, the maximum risk is also predefined and limited to the difference between your strike prices minus the net premium received. Think of it as an insurance policy. You know the maximum you'll have to pay out if things go south. This limited risk, limited reward structure makes the short iron condor a strategy favored by those who prefer a more calculated approach, knowing exactly where they stand from the get-go. Before you jump headfirst into a short iron condor trade, it's crucial to understand that this strategy works best when you have a neutral outlook on the market. What do I mean by neutral? It means you don't expect the underlying stock to make any wild, unpredictable moves in either direction within the time frame of your trade. Remember, we're banking on the stock staying within a specific range. If it suddenly shoots up or plummets down, our carefully crafted condor could get clipped. So, if you're feeling bullish or bearish about a particular stock, the short iron condor is probably not the right strategy for you. This is all about playing it cool, steady, and neutral, capitalizing on the market's indecisiveness. Procter & Gamble in play a practical example of the short iron condor. Let's bring this strategy to life with a real-world example using Procter & Gamble, often referred to as PG, a company known for its stable stock performance. Imagine it's May 7th, 2025, and PG is trading around $150 per share. You believe the stock will stay within a tight range for the next month. You decide to enter a short iron condor strategy with the following options, all expiring in June 2025. Sell 1 PG, June 145. Put you receive a premium of $2 per share. Sell 1 PG, June 155. Call you receive a premium of $1.50 per share. Buy 1 PG, June 140. Put, you pay a premium of 50 cents per share. Buy 1 PG, June 160. Call. You pay a premium of 75 cents per share. By selling both a call and a put option closer to the current stock price and buying further out of the money options as insurance, you've created your short iron condor. Placing your bets. Entering a short iron condor trade step by step. Now, let's break down how you'd actually enter this trade. Remember, options contracts are typically sold and bought in lots of 100 shares, so keep that in mind when calculating your potential profits and losses. Make sure your brokerage offers options trading. Ensure you have sufficient capital to cover potential losses. 3. Select PG, search for Procter & Gamble within your brokerage's options trading platform. 4. Choose the June 2025 expiry. This aligns with our 1-month time frame. 5. Select the strike prices. As in our example, choose 145, put, 155 call, 140 put, and 160 call. 6. Enter the order. Ensure you're selling to open the 145 put and 155 call, and buying to open the 140 put and 160 call. 7. Review and confirm. Double-check all details, including the premium received and paid before submitting your trade. Congratulations! You've officially entered a short iron condor trade on PG. Now let's talk about managing it. Watching the clock. Monitoring and exiting for maximum returns. Once your short iron condor trade is live, it's time to put on your monitoring hat. You don't want to just set it and forget it. Keep a close eye on PG's stock price. Ideally, you want the price to stay within that sweet spot between your 145 put and 155 call strike prices. As the options approach their expiration date, their value will erode, working in your favor. There are a few ways to exit the trade. 1. Let it expire worthless. If PG stays within our range, the options expire worthless, and you keep the entire premium. 2. Buy back the options. If the trade is moving in your favor, you can buy back the options you sold to lock in profits. 3. Close the position early. If PG's price moves against you, consider cutting your losses by closing the position before it's too late. Remember, managing your trade effectively is just as important as placing it correctly. Stay vigilant, be prepared to adapt, and don't be afraid to take profits when you see them. Weighing the scales risk, reward, and the beauty of neutrality. So, there you have it. We've explored the ins and outs of the short iron condor, from its preference for volatile markets to its limited risk and reward profile. Remember, this strategy is all about finding that sweet spot of neutrality, where you're essentially profiting from the market's indecision. It's like being the calm eye in the center of a hurricane, reaping the benefits of the surrounding chaos. Of course, no investment strategy is without its risks, and the short iron condor is no exception. But by understanding the mechanics, carefully selecting your trades, and monitoring your positions diligently, you can potentially harness the power of this strategy to your advantage. Final thoughts. Is the short iron condor right for you? As with any investment strategy, it's crucial to assess your own risk tolerance, investment goals, and market knowledge before diving headfirst into the world of short iron condors. This strategy can be a powerful tool for generating income in volatile markets, but it requires careful planning, consistent monitoring, and a clear understanding of the risks involved. If you're new to options trading, I highly recommend doing your research, practicing with a demo account, and perhaps even seeking guidance from a qualified financial advisor before putting real money on the line. Remember, trading always involves risk, and past performance is not indicative of future results. However, with the right knowledge and a healthy dose of caution, you can navigate the exciting world of options trading with confidence and potentially reap the rewards. Thanks for watching, and good luck with your trading. See you next time.